session you're attending today is on how can digital finance tools help energy access companies access more and better financing, and what they can do to prepare themselves better. On our panel today, we have a blend of financiers, but also digital tool providers or platform providers. I'd like to begin the session with understanding how many private sector developers we have in the room. So if you could please raise your hands just for us to know whom we're speaking to. All right, we have 3 private sector developers, that's nice. And how many financiers are in the room? Could you please also raise your hands? All right, 2 or 3, good. So now we know whom we're talking to. I'd like to invite my panelists here to introduce themselves one by one. Please feel free to introduce yourselves, tell us what you do, and also how data or digital tools plays a role in the work you do. I'd like to begin with Roeland from Nithio, please.
Thanks. Oof. This works?
Yes.
Does it work like this as well or no? Perfect. So my name is Roeland. I'm the Chief Revenue Officer at Nithio. Nithio is a debt investor in the energy access space. We invest debt in companies that do solar home systems, productive use appliances, e-mobility, C&I. We use data to make those investments. We build an algorithm that can forecast the performance of any future receivables for such portfolios of companies. So let's say you're a solar home system company, you deploy a couple of solar home systems in the field and now you wait for the money. We build a tool that's using satellite data, macroeconomic data, demographics and other existing repayment data from other solar home system providers. And we can start forecasting the performance of your receivables. So we know the value of your receivables. So let's say you have 5 million of face value. If everybody would pay in 3 years' time, you'll get 5 million. We know that, for example, only 3.5 million will come in. Then we take a discount to that to account for interest rates and a headroom for that. So then we will be able to advance your loan of, let's say, 2.5 million. And so you instantly get the 2.5 million, so you don't have to wait for your capital, and you can start deploying more systems. So we've been doing this in large companies as well, small companies. Our portfolio consists of the larger players in the sector like D-Light, Sun King, but we also work and we mostly focus right now on locally owned, locally operating companies. So the smaller ticket sizes that are left in market. As we've seen, market is developing, larger players arise. There's the trend of like acquisitions and consolidation is happening, both in solar home systems as productive use appliances. But we see this missing middle, that's the engine of the economies that we're serving. And because we have these tools, we have a lower perceived risk profile, because even with very limited financial data, we are able to offer you debt financing and help you grow. So we work in Nigeria, Kenya, Uganda, DRC, and 20 other countries in sub-Saharan Africa.
Thanks, Roeland. I'd like to move to Maxime. Would you like to give us an introduction to yourself and also the GGF, please?
Sure. Thank you, Divya. So I'm Maxime Marion. I'm the Managing Director of GGF, which is the Green Genset facility. We're a financing facility that provides inventory financing, so essentially working capital for solar distributors. We focus at the moment on large solar home system and productive use of energy, and our approach is quite simple. We really focus on making the access to financing and access to inventory easy and low cost to solar distributors. So we have a very fast track assessment process and due diligence for a first tranche, and we have this first investment is capped depending on the size of the company. Up to now we have investment ranging from $30,000 to $250,000 in the first tranche, and then after this first disbursement, we start monitoring not only if the company repays us, but we have actually a deep focus on, similarly, I think, as Nithio, somehow on the customer portfolio. But it's more, well, it's not a refinancing, it's a direct financing of the inventory and the customer cycle. We actually use that using the Prospect platform, which I think will be widely discussed during this panel. And this monitoring, this real-life data, informs us on how good is the company performing on its customer portfolio, but on generally speaking, on its unit economics and on its sales pattern. And we use this to basically reconfirm or not our investment thesis. And if things are going well, we then invest a second tranche and then a third tranche. And the idea is really to provide continuous access to inventory financing, which arguably should be the bulk of the investment capital required by the company on a continuous basis.
Thanks, Maxime. Ray, you're next.
Thank you, and good morning, everybody. Oh, yes, it is still just about. Good morning, everybody, and thank you for joining. My name is Ray Coyle. I'm the CEO of Energize Africa. We're also a debt provider in the sector, and we focus on providers of solar home systems and developers of green mini-grids in sub-Saharan Africa. We're a little different to some of the other debt providers in that we're a crowdfunding platform. So all of our funding comes from individual investors. We're based in the UK. The majority of our investor base is in the UK. So we rely on those individual investors to make the investment decisions and to decide which of our investee companies they want to entrust with their money. So for us, it's really important that we get very good quality and very reliable data from the companies that we're proposing that our crowd invests in, so that they can make a very well-informed decision. And similarly, we tend to invest in tranches, so monitoring of the data from the individual investee companies is very important. But it's not just about the collection data and the financial data, but the impact data is also very, very important to us. Our investors want to invest in impactful companies, so it's really important that we get very rich and reliable impact data as well.
Thanks, Brianna. Please take it. You need to press the button on there? Yeah.
Okay, great. Yes, so I'm Brianna. I'm the Director of Digital Product for the Access to Energy Institute, specifically working on Prospect. So our team is a lot of people that used to be in industry, Offgrid, or most of the team used to be in the Offgrid solar industry, and realized that we had a lot of resources to look at our data and have a lot of transparency into trends and understanding the data itself, but this was not a widespread benefit. So we now work at this institute. We've created an open source tool, Prospect, as is in the title of the panel, which integrates data from a bunch of different CRM systems, meters, inverters, sort of anything having to do with energy storage, pay-go loans, etc. We're trying to pull that data in and standardize it in a way that a company can use the interface to see their data, to understand their own financial health and portfolio health, also to be able to look at meters, look at energy usage, etc. So it's useful both for the company themselves, but then also for large funders, large donors that want to be able to have more access into the nitty-gritty details of the data and to have better verification, digital verification, monitoring, etc. And then also for funders to be able to access data in a standardized way to be able to better understand the financials without having to go into the specifics of the CRM system necessarily. So we're working closely right now with Maxime and GGF. Also have been talking to a couple other of the financial organizations to see how we can be of benefit. And I just want to stress that it's all open source. It's all available publicly. We're not a for-profit or anything like that. So we're just trying to fill a hole that we saw in the space, and we've managed to get generous funding from several donors and countries to do that.
Over to you, Siten. Thanks, Brianna.
Hi, everyone. I'm Siten. I'm the CEO and co-founder of Masunga, formerly Solaris Offgrid. And we develop technology solutions to enable scale in access to essential services, including access to energy. We work mainly with distributed renewable energy companies. The main two platforms that we have, one of them is called PayGops. PayGops is a operational management tool, set of tools for distributed renewable energy companies, for example, to manage the operations, manage credit given to the end customers, payments, agent networks, so a variety of tools to manage companies' operations. And then another product called Bridging, which is a platform that allows off-balance sheet financing of aggregated receivables. So for the companies that we work with that have pools of credit that they provide to their end customers or receivables on their balance sheets, we have a legal platform, a legal entity that we are able to aggregate those receivables into from various companies and provide those receivables as an investment opportunity for institutional investors. So that's the Bridging platform. So to date, we've managed over $100 million of loans through PayGops, and we have onboarded about $30 million of receivables onto the Bridging platform. And so, yeah, the data side is really important for us, of course, as we, to be able to do receivables analysis, we use a lot of that data, and the accuracy and the predictability of that data is really crucial to be able to value that receivables and put a price on it for those investors to then invest in.
Thanks, Siten, and everybody for setting the scene a bit. I'd like to circle back to you, Ray, to understand. So you have retail investors in the UK who crowdfund projects in Africa. Have you seen any patterns around the digital tools that these projects use, or storytelling, or in terms of data that has actually worked for them, and perhaps also what doesn't work in some cases?
I think the first part of the question is really interesting. It's patterns that we're seeing among the developers and distributors, and we're not really. There's very little standardization. There are very few patterns of behavior within the marketplace. You would expect. It's a very large market, lots of different countries, so you would expect a great degree of fragmentation and difference in the different marketplaces. But I think one of the very difficult burdens that is placed on the developers and distributors by us, the financiers, is that we're all asking for data in different forms, and we're all asking different questions, and we're asking in different ways. And it's difficult to be an entrepreneur. It's difficult to run a business. We all know that. And I think it is incumbent on our industry to try and do better at standardization. I think this is one of the things that hopefully Prospect can bring. Because what we as financiers need to work toward is a world in which the entrepreneurs know what data that everybody is going to ask for, and know what format they need to collect and they need to present it in, so that they can reduce the burden on themselves and reduce that overhead. Because we really need management teams to be focused on developing their business, on building a successful company, not on trying to tailor lots of information to different financial investors in different ways. So I think it's really the finance side of the industry that needs to drive that standardization. And then the second element of your question, what works and what doesn't work. And I think that what we find works with retail investors is a combination of pure data, number of people reached, number of hours of lighting provided, etc. That really reliable, solid data, and also the storytelling element of it. Because we rely on individual investors, we we're an impact platform, so people are investing on Energize Africa because of the impactful nature of the investments that we can make and the use to which their money is put. So reporting back to those individual investors and telling them how the company is delivering energy access and who it's delivering energy access to is really, really important. And that's easier for some businesses than it is for others. If you're selling high volumes of solar home systems, solar lanterns, it's more difficult to build that kind of that rich storytelling. If you're building a mini grid in a particular village, it's much easier because it's far easier to communicate that and to show the impact on the community. So I think it by its nature, it's easier for some businesses than others, and I don't think we'll ever get to a point where the storytelling element of it is standardized, but I think that the data side, we, the finance sector, need to help drive that standardization to reduce the burden on entrepreneurs.
Thank you. I'd like to veer to you, Roeland. Do you also see it similarly in terms of how you at Nithio are making credit risk assessments? Do you also have a need for standardization that could, let's say, benefit companies that you work with?
Yeah, definitely. I think that it's a great point because so we do investments, debt investments ranging from 500K up to 5 million. And if I do a 5 million deal or if I do a 500K deal, it takes me the same amount of time, the same amount of efforts. But if I charge 10% interest rate, the 5 million deal is way more profitable to me than a 500K deal. And actually what we've seen that the 500K deal or even lower than that, they take even more time because all the data is not standardized, because everything comes into an Excel file or a Google Sheet. And so to clean the data, as said, like we use tons and tons of data to assess the value of those receivables. If we get it in a ready-made format that we can ingest into our risk analytics engine, then it makes our job way easier. So if I work with companies that integrate with Siten's company like PayGops, I know exactly how the data will come to me because the customer is using the same platform. So any company that's using PayGops can easily be integrated into my company's data software, and then I can make these loans way quicker and way easier. We want to move to even smaller and smaller loans, so to 250K, 200,000, or even $100,000 loans. The only way to do that is to fully automate those processes. And so I would recommend everybody who is starting a business or scaling up its business to look into how do I standardize these data streams from the get-go. Because integrating later on with an Angaza or a PayGops can be messy. Whereas if you just start and from the get-go you have that systems ready and set in place, then you'll become eligible for funding much quicker because you make the life of financiers much easier.
Thanks, Roeland. Siten, like he already mentioned PayGops on there. How does this play out in terms of also the AI-based tools that you're, the receivables platform that you're running?
So, yeah, in our case, where on the PayGops side, the two platforms are actually completely separate. So, those companies that do use PayGops, indeed, it makes it a lot easier for them then to get financing through our Bridge-in platform. But actually, Bridge-in connects to other platforms as well. And one of the things that we look out for how companies can easily get access to receivables financing through Bridge-in is that good, consistent data about the receivables. So that's also about the company's position and how mature they are and what type of products they've had in the market for how long and their existing outstanding pool of receivables. So really that's company by company. But then the data side, as Roeland was suggesting, that it's really important to get those systems in place as early as possible. And then just having a mechanism to also tell that story about what's happening with your with your cash flows, what's happened in the past. If you do introduce new products or you have changes to your organization, you have some methodology for cohort analysis to separate, this was the past, this is a different product, and these are new products in place, or new credit process that you're applying. That's really key as well, that the data platforms allow for that, or the systems put in place, how they may be put in place, allow for both the testing and the cohort analysis. And then from that, you're able to tell that story of, this is what our cash flows will look like based on this historic data. So I think that's an important part of what we consider when we're looking at companies.
Thanks. I'm a bit curious, if I were a new project developer and I'm just setting up my business, at what point of time in my business journey would it make sense for me to actually consider gathering data the way you're mentioning, right? What would be the cost to benefit of it? Because obviously I'm quite busy trying to run my operations. I don't have, let's say, a large HR team in place to take, or a management team in place to take care of things. So how would you express the benefit of this to a company like that?
Myself?
It could be, please feel free to respond, or anyone else.
Yeah, it's an interesting question. I can start. So, indeed, it wouldn't be the very, very first thing you'd set up as a project developer, but you'd still need some method of tracking what your organization is doing. So a minimal level of data tool there in place to prove out essentially what you're trying to do in the business in the early days, is prove out your product fits the market need. And so, depending on what that project is, it can vary quite substantially. But if it involves if the project involves hundreds or thousands of different customer contracts, to be able to become a successful project in the future, you need a certain good level of data to base that assumption on. So then you need a tool to be tracking that. If it's a large scale, if it's a mini grid and there's one off taker, you're not going to be implementing the data tools to begin with necessarily. So,
thanks for addressing that. Brianna, on the topic of gathering data, and I also know that you've, in your past role, also worked in a solar home system company on the ground, right? Could you speak to what constitutes future-proofing data, and how best companies on the ground can work with, let's say, a platform like Prospect to also capitalize on the fact that financiers or donors work with you as well?
Yeah, so I can say, I would echo what Roeland and Siten have said. It just, as much as possible, digitizing as early as possible, both in the life cycle of the company, but also in the life cycle of sales. So, for example, with SHS, if you have access to some. Okay, is that better? Okay, great. So I was going to say, I'm echoing what these guys have already said of really trying to start digitizing as early as possible, both in the life cycle of your company, but also in the life cycle of a single sale. So really, if possible, having a sales agent enter information on the sale into a mobile application instead of on paper, for example. And then all of that information gets centrally stored to have some sort of historical change log of what happens. This will help to prevent fraud and things like this. And identifying trends very quickly based on the data that you've got. I think in terms of putting it into Prospect, the thing that's easiest for us is if we're working with CRM systems, or with companies that are using CRM systems that have data that's very readily available. So this is a bit technical, but if the CRM system has a really good API documentation and a setup where they can really easily integrate with us. I think that might not be the first thing you would think of as a mini-grid developer, as an SHS distributor, but I would think that not only is that helpful for sharing the data, but also that should give you some indication of the value system of the platform developer themselves and how they're considering data storage and all of this. So yeah, that would be my answer.
Thanks. I'd like to bring Maxim into the conversation here. We've spoken a lot about data gathering, and how crucial it is for different reasons. But of course, as a company, I'm also concerned about the privacy or the safety of the data I'm sharing. And as a financier or as a funder, in your case, how do you strike that balance between accessing the data, the right data that you need to make your decisions, but also not overdoing it in a manner and ensuring also data privacy at the same time?
Yeah, thanks, Divya. I mean, on the data privacy, I think it's paramount, but it's also very straightforward. At least the way we work with prospect, and I think the way most platforms work is that, usually the customer information is actually not transmitted the way we work with prospect, and Brianna will explain in details if need be, more than I could. But things are, we have some information on the type of customer, the kind of average location, but we're not able to localize specifically one customer or per name or anything like that. So the privacy of the end customer is respected. And then the, let's say, ownership of the data really remains with the company. We're using the data to make investment decisions. We're using the data or some aggregate of the data to do some reporting to our own funders, financier, but only within, let's say, what is permitted and what is allowed by our data privacy policies, and we want to be very, very clear to the companies of what the data is being used. So I think it's a very critical point, and it needs to be super clear, but once things are clear, are important. Maybe just one last addition to the points before on data, mostly to the companies out there. I think we need to find the right balance indeed between the type and amount of data we're sharing and the reason why. Indeed, it's very important, I think, for either investors, lenders, or donors to have access to a lot of data. If they are not reasonable, then we need to, also take a look in the mirror of, okay, why are we asking this? But for developers and operators out there, I think it's also to understand that if you see data just as something like a pain that you have to report to get funding, then we're missing something. The whole idea is that we're using this to make decisions because it should be data that is useful for you as companies and as operators. I mean, we see that now every day with GGF and prospect dashboards, is that it has to have some value. If the data we're using is not useful to the company, then, I mean, so somebody is wrong there. And what we see in most cases is that if we look at the right type of data, and that's where the level of effort versus the value, and we need to find the balance, but it has to be useful both for operational purposes for the company and for funding or financing purposes.
Yeah, I work in the M&E part of GET.invest Finance Access Advisory, and I completely see what that means. We also have to quite regularly revisit what is the kind of data we are gathering from each of the beneficiaries. On that, Ray, I know that you also need to gather data to submit, let's say, to the retail investors in the crowdfunding platform. How does that look like? How do you go about gathering this? Because obviously you work with many different projects, if I'm not wrong.
It's an interesting question. We try and be as flexible as we can with the individual companies that we're working with, and that doesn't make it particularly easy for us. We're not standardized in terms of the data that we're gathering from different companies. There's lots of commonality, but what we're trying to do is to understand what data the investee companies are already gathering, what are they using and how are they using it, and then we're trying to adapt that to report back to our crowd investors. I think it's really important to acknowledge some of the difficulties and the burdens that this places on the developers and the operators. And I think to echo Roland's point earlier, lots of investors like us do want to reduce the ticket sizes, and we do want to fund more local businesses, and we want to fund smaller businesses. But smaller businesses have smaller teams, and it's not easy to keep consumer data secure and up to date and current. This is a big ask of companies. And I think that what we've got to be careful is that we try and ask the same questions as much as possible, and that we don't place too high a burden on the companies. Because what we don't want, and I think Maxime's point is, we don't want to push entrepreneurs into gathering lots of data for finance companies. What we want is entrepreneurs to be running good, successful companies, and the data should reflect that success. It shouldn't be driving the way people are running their businesses. So I think for us, at this point in time, we're trying to be flexible and work with what the company has rather than impose our own data standards on the companies.
I'm wondering if one of the other tools that we have here in terms of prospects or bridging or even Nithio's AI tool, would that, for instance, be a way for Energize Africa to gather the data that they eventually need? Please feel free to respond, whoever it's relevant to.
I think we're very interested in the work that Prospect is doing, and really glad to see that that's open source. I think it's the right way for this to work. I think as a lender, our sister platform LenderHand is working very closely with Nithio, so I think there are definitely opportunities for collaboration. But I think it's more important that for the sector that there's standardization than collaboration.
Yeah, if I can quickly add to that. Sorry. So the standardization and the data, indeed, I completely agree. The data needs to fill this gap of knowledge. And so we're working with Superpower Africa Fund that's setting up even lower amount of facilities. So they say, well, let's just get people alone, and when people repay, that gives you data that people repay and repay and repay. And in the meantime, they're like an industry builder, so they can take these investees by the hand, tell them, well, start using pay gobs, make them investment ready for platforms like Energize Africa or for Nithio. So the moment they reach the 500K point where we can step in, or hopefully in the future something smaller, it's already prepared. It's like a red carpet that's rolled out. And I think we need way more of those initiatives. The point obviously is that those are not yet proven. Are they profitable? Is this a private sector initiative that should be led by private sector? Who's willing to invest in that? Who's willing to prove that this is actually working? Yeah, so that's a key challenge that we're facing.
Maybe I can add something just quickly. So one of the other aspects that we're trying to, one of the things we're considering is this inclusion of smaller organizations, so specifically to make it as easy as possible for them to share the data in a standardized way. Like when I was with NG before this, and we had a data team of 8 to 10 people at any particular time. I know that is not the case for most organizations, so we're trying to take that burden off of them and make it just, okay, I use this standardized CRM, I press the button, I import the data, and then I see it immediately.
Just quickly add that we already have some examples of this, CRM data systems being linked up and directly enabling financing to happen. For example, the rural electrification program in Nigeria was run in a quite streamlined, automated way. In our experience with the PayGops platform, that was running for organizations. The data was provided via API to a platform that was managed by the rural energy program there, and then that proceeded to disperse, to manage the disbursements directly. So there was very little manual report making, and as far as I understand, it worked very well, successful for the companies involved and the organization. And then that proved a model that it could be scaled up quite extensively, and hopefully in the coming rounds there, and in other governments as well, looking at that. So that's I think it's results-based financing from the government, but also results-based financing from other organizations.
Do I understand you right then that, for instance, in this case, you've mentioned results-based financing, that technically other results-based financing funders can also use the same platform and the same process? And yeah? And if that's the case, why do you think that might not be taking place right now? Why is everybody going off in their own way to gather data?
I'm not sure what's happening on the results-based financing organizations that have the opportunity to provide the capital. The data is there, the tools are available, and it's been proven out that it functions. So I think maybe it's just a matter of time to putting the new RBF programs in place. There are a few coming, so maybe there'll be more examples soon enough.
Maybe I can just add quickly with Ascent rolling up, or Ascent, beginning to grow, and then M300, all these programs that are really encouraging RBF programs within countries across sub-Saharan Africa. We're already having a lot of conversations with many RBFs that are starting and trying to figure out what tools they want to use.
Yeah, and to add to that, I think for result-based financing, what you also need is data. Because what is the result that you're financing? How do you measure it? Again, the data angle is the most important one. Because if we can do result-based financing with just little amount of data, then we're not really sure reaching the target. So, for example, with Nithio, with our tool, we're working right now on a result-based financing proposition where actually we can drive strategic decisions. So let's say you can either reach with a certain amount of result-based financing 100,000 households that are nearly there but just need a little bit of subsidy to get there, or you can take, let's say, 20,000 households that will never be there and we subsidize them highly. So what's the higher impact, right? Those are strategic discussions that we need to have, but those discussions you can only have if you have the data, the knowledge, and the tools to drive those discussions.
A very good point there. Maxime, so Roeland mentioned earlier that for them to scale down to smaller ticket sizes is quite expensive. And I know that the GEGF is actually working on quite small ticket sizes. So how do you afford to do that? Perhaps it's a interesting point for everyone here.
Yeah, thanks. So indeed, I don't want to say we specialize in small tickets, but I mean, we launched and created GGF a year ago to address that, because I think there is a number of very valid reasons. I mean, it's kind of obvious, as Roeland was saying, that the economics of small deals either do not work or are harder to achieve. So that's where we've put GGF in place. The ticket size we offer for the first tranche I was showing, we kind of have a repetitive type of investment pattern, but the first tranche is can be as low as $5,000 or $10,000 for a loan, which is like extremely small. We of course don't make much on that. The interest, the 10% interest rate on this won't bring much in our pockets. But there's two things. First is the beginning of the journey, and the idea is that pooling those and then reaching a certain scale then make the economics of it better. Second point is that we really invest a lot of our time and effort into making the transaction cost and time as low as possible. For example, we now at less than 2 months between first contact and investment decision for the first tranche, because again, we also cannot afford to invest too much, and we'd rather invest the, let's say, due diligence money into a small loan, kind of referring to the Superpower Africa type of, let's say, thinking. And the last bit is that we're supported also by philanthropic capital at the beginning to allow this test and learn approach, because right now GGF is not profitable given its size, but it should be reaching a scale that makes it viable. Thanks.
We probably need a lot more of the GGS out there. I'd like to
Can I ask
open.
a question just
Yes,
quickly?
please.
So, because I'm very interested, because then at a certain moment you reach a certain scale, and then all of a sudden the big investment funds and even the DFIs at a certain scale are interested. And then they hijack your customers. So you build them up, you're the red carpet, but the biggest reward comes into the hands of the larger funders, right? So how do you deal with that? And yeah.
Thanks. Well, two things. It's not necessarily a bad thing. First, because then we can do something else. I can take a break. But more seriously, GGF is a non-for-profit financing facility. We've really been set up by the sector for the sector to address this gap. So we're not meant to necessarily finance each and every company at each and every level, and that's where it's a non-for-profit, meaning we do charge interest, but we're legally not allowed to pay back anything to shareholders. We virtually have no shareholders, and so profits will then be reinjected into the social purpose by lowering interest rate or allowing for bigger loan loss reserves. So it's actually a very good news for us if we bring companies up to a certain ticket size where others are, let's say, better suited, because we also might not be best suited to do a 10 million transaction.
All right, if there are no more comments from your side right now, I'd like to open up the floor for questions. Please, someone hand him a mic there? Could you please identify yourself, where you come from, and and ask the question?
Good afternoon, everyone. My name is Jasper Iheme from Nigeria. I work with a company called Mainstream Energy Solutions. At the moment, we're investors in the hydropower sector. We currently have assets under management of around 2 gigawatts. However, we're trying to diversify a little bit into the DRE space. And incidentally, we also applied for the DARS program in Nigeria with the Rural Electrification Agency. The selection process just happened, and we're waiting for the RFP. So here, for me, it's just a fact-finding mission, so to speak. So I just wanted to ask a couple of questions. I heard a lot about receivables financing, and I was wondering, usually when I hear receivables financing, it appears to be short-term. So I was just wondering, do you have long-term options, or are they future receivables that we're looking at? Secondly, I wanted to find out what kind of rates that you're offering. I think for the Roeland, I think, yeah, and also for the crowdfunding platform. So I want to find out what kind of rates you're offering and what currency those loans are in. Currently in Nigeria, I think anybody that knows Nigeria understands what our exchange rate problems are today. So you understand that taking out loans today in Nigeria, receivables in Naira, and if I take out loans in foreign currency, it's a very huge mismatch that offers a lot of risk to us, as a company. So I just wanted to find out what hedging mechanisms you have for loans in currencies other than Naira, and if you have swap deals with any country or any FI in Nigeria that helps, that hedges this exchange rate risk. Thirdly, I think this is for Siten, I guess, yeah. You talked about both Siten and actually in Nithio, because you also echo the fact that if you use the platform that Siten offers, it makes it easier for you to analyze the data and all that. So, but yesterday during the plenary session, the gentleman mentioned something about overheads and understanding that for DREs, you usually stay in the rural area, you play in the rural sector, right? where the purchasing power is really very low. So keeping your overheads at the very minimum helps you with your tariff, particularly in a country like Nigeria where we have some sort of government or regulatory intervention in tariffs, where you're kind of regulatory barred from just charging arbitrarily. So I'm saying, my question now is, Siten, how does your platform, how costly is the platform, and how does it add to the overhead for small companies, especially companies playing in the rural sector? Thank you very much.
Please go ahead, Siten.
I can start. There are a few questions there for others, I suppose, that let you chime in. But I can go ahead and answer the first one about the term of the receivables financing. So the way we look at it is actually longer term. When we say longer term, so one to 2 years of receivables, average maturity of the receivables that you have is a good time frame for us when we're looking at us and our institutional investors. So it could be that, it could be even longer, but that's the typical types of companies that we're looking at, and we're seeing it make sense. If it's really short term, so we do see in other spaces, normally in the fintech side, financing of 30 days and sort of really short term financing tools, but what we're doing is focusing on the 3 months to 2 years, that sort of time frame. In terms of rates, we're matchmaking between institutional investors and the receivables generators, the originators. So it really depends on how they assess the risk, and they look at the risk in a few parts. So it's the exchange rate risk, the default risk of the portfolio receivables that are being invested in, and the risk of the originator as well, how robust those systems are and processes are to collect, essentially, in good conditions and in a default situation. And then, in terms of hedging, again, what we're seeing is there are a few solutions that are out there being provided. Normally, there's for markets like Nigeria, we're seeing discussions around subsidized hedging solutions, but they're usually like blended into funds that are targeted to certain countries. And so we haven't worked with them yet, but hopefully there are solutions like that coming. And then those would be the institutional investors that we would talk to, and then they would provide investment through the platform into a market like Nigeria, where they would have already solved or have some predictability around the Naira risk. And then in terms of PayGops costs for, the overheads question you had. So yeah, it's a good point, and that's one of the reasons why, with the pricing of PayGops, we've made it a usage-based pricing. So it's per contract that it's managed per month, and I think the typical average fee is around 20 US cents per contract per month. So you could apply that to the scale of the organization and see if that makes sense. So yeah.
Yeah, I can add something on the Naira. So we've done a couple of deals in Nigeria, and we understand the issues with the Naira, obviously. So the way we go about this, we set up partnerships with local banks, and we make a back-to-back structure. So let's say your company takes out a $500,000 US dollar denominated loan. I will deposit that $500,000 at, let's say, Sterling Bank in Nigeria. That's collateral for a loan to you. So Sterling Bank would otherwise not lend to you, but they will lend you the equivalent in Naira, and you pay back to Sterling using the collateral that we offer. And so that relates directly to the rates, because we charge US dollar denominated rates. I have my own investors, so we have 50 million of assets under management, mostly DFIs that want their money back and also want to make a return. Especially in the current interest rate environment, my cost of capital is going up. It's all floating rates. And so I need to translate to the borrowers as well. That being said, if it's an institutional company or a large company that I've already worked with and known for a while, you'll see a different rate that I'll charge compared to a new company, a smaller company, and unfortunately that's also true for locally owned, locally operating companies. We need to charge higher rates because of a higher risk. Generally, lower double digits will be our US dollar denominated interest rate, and then the cost of the hedge is added. That's fully at the cost of the borrower. So we don't take any margin of that, but if Sterling wants an additional, let's say 8% for offering the Naira, then that will be your rate. Your question on the term, so receivables financing, we see receivables being typically 1 year to 3 year cycles. So we're offering a 1 year to 3 year loan. Again, this completely depends as well on the size of the loan. Have we worked with the company before? What's the collateral? What's the advance rate we're offering? So it's always a combination of term to make sure we get risk-adjusted returns. So sometimes we have single-digit interest rates in US dollar denominated, lower double digits. It always depends on the value of the receivables and the value of the underlying collateral.
Thank you. Does anyone else? Please go ahead.
I think I certainly understand we've been operating in Nigeria for quite some time, and the challenges around exchange rate are really, really difficult. We spend a lot of time and a lot of effort looking at trying to put together FX hedging products, but the cost for hedging Naira against the dollar is incredibly expensive. And we were just unable to find a product combination that would then be attractive to the marketplace. When we went back to Nigerian companies that we work for, and we said, well, we can, if we find a way to do it in a Naira-denominated debt, this is going to be your interest rate. And every company we talked to said, okay, well, we don't want it, we'd much rather have it in GBP as we lend, or dollar, because it was just so expensive. I think we were encouraged to see that the DARES RBF program is paying out in dollars. So we're talking to a lot of mini-grid developers, particularly in Nigeria, about lending against the RBF contracts. And the fact that that's the dollar denominated really helps. And up until about a week ago, we thought that the GBP USD currency risk is pretty negligible, but the world went a bit crazy in the last 7 days. So I'm expecting to see quite sharp increases in any kind of hedge, futures, or swap options, because as soon as you bring huge amounts of uncertainty into the global economy, then the prices of all these the financial instruments go up. So it may be something that I'm afraid gets more difficult rather than easier in the short term.
Although the Naira, it had a very strong run recently, right? So there's also upside in getting that funding in Naira.
Thank you. Any other questions for the panel? Going one, going two, going thrice. All right. I'd like to take us through concluding remarks with your individual caps on, of course. For instance, Roeland, if you think there are particular things that young entrepreneurs can do when it comes to data, digitalization, digital tools, etc. And the invitation is for everyone else too. Roeland, please.
Thanks. Yep. I can be very brief. I think that for any company in our sector, data should be considered as your friend. I mean, the more data you have, the more you can make use of it. And data-driven investments will grow, digital investments will grow, automated lending will grow. We are actually working on an automated lending platform. So think about the AI chatbots that you're currently already having. Like in a year from now, you'll just upload financial statements. That's easy. That can be read out. I can calculate my financial due diligence, my ratios, everything automatically. But the key will be the quality of your data. How do you integrate your data? How much data do you have on your customers? And within privacy reasons, of course. And so that will determine the quality and the value of your data source. So for us, I think going forward, standardize, use the existing tools that are there. Also look at what others are doing in market. Look at what the successful players are doing. For example, one quick example, but if you're a solar home system company, and everybody else in this sector in all countries are charging a down payment, then it might be smart to also charge a down payment, because it will affect the data stream, it will affect the repayment profile that we as Nithio, for example, build our engine on. So if you come to me with a more exotic product, it will be less likely to get funded. If you get more standardized products, it's more likely to get funded.
Thanks. Maxim, please.
Thanks. I second that, of course. Briefly, I would say, for me, it's about transparency. I think the industry has learned a lot in the last 10, 15 years. A lot of mistakes were made. If I take the view from a, let's say, funder or investor point of view, a lot of money was lost and all will be lost. That's unfortunate, but it's just the hard truth. But it's all not everything is dire. I think there's still a massive need, and based on all these learnings, we can do much better. We see so many companies are doing a fantastic job. But where data comes in for me is, well, making data-driven decision, operating better on the ground, but providing this transparency that will then put everybody at ease and unlock the massive amount of investment that we require, whether it's on a donor basis or private investor basis. And this transparency comes from the data and from the willingness to share it within privacy reason, of course. But if you have nothing to hide, whether as a company or an investor or anything like that, why not share it? Because then that unlocks this confidence and the associated funding that comes with it.
Thank you. Ray, over to you.
I think we've talked a lot about gathering a lot of data and making sure that you have a lot of data. But I think it's really important to remember that data is not magic. It won't make your business successful. You can have a lot of data and still fail. So what's really important for a successful business is how the data is being used, how you're using it to make better decisions, and how you're taking that data and improving your own organization and improving your own collection rates. So I don't want people to go away thinking it's just, this is all just about gather, and the more you have, the better. It's not about quantity, it's about the quality of the data and also the way in which you use it and who in your organization is using the data and what decisions they're making based on that data. So it should be a tool for business success rather than just a means of accessing finance.
I can say one thing that that we consistently hear from funders, either donors or investors, is the desire to have just trust in the data that's being given to them. So if it's possible to do mobile money payments instead of cash, to like incentivize a mobile money payment instead of cash, for example, so that there's a record of it and it can be third-party verified. IoT data, when it makes sense, can also be used for verification purposes. So these types of things are worth thinking about, and it'll be specific to the use case, but just worth considering that like there are certain types of data that will, yes, will give you more access to finance and funding because your product is more trustworthy.
Please.
So I think about this from the perspective of the sector that needs, tens of billions of investment over a fairly short period of time in the next few years to meet access goals, and how that could be potentially provided to the market to meet that need. And the only way it makes sense, where you have local providers, that are in the market, that are present, that need access to this funding to be able to provide the solutions. So it's relatively small companies, a lot of them, and large amounts of capital. There needs to be efficient, standardized, data-based ways of providing that finance. And there are the tools available, the various platforms that we're all presenting. So the pieces are there, and we're connecting them up. Practically are connecting them up in different ways. So, you do see that happening, where it does become eventually a more streamlined, automated, and standardized way of getting that funding out to the companies that need it and financing the solutions. But yeah, it does need at the ground level for companies to implement those trustable systems that provide that underlying data. And if those trusted systems do have some challenges, then that sort of breaks the whole model of streamlining it. So there's a couple of things that we think about when we're doing due diligence from the bridging perspective for particularly companies that have built their own systems. It's a real challenge because on one hand, companies want to be lean and make simple technology systems in-house, put it together and then get going, and that's great. But at some point, third-party systems are also really useful because they have that added layer of we know what it is, we know how it works, we can trust it. It doesn't have the potential for manipulation. If it's your own system, you can tweak the code and nobody will know. But so there's benefits there of using the off-the-shelf solutions that we're all presenting and getting them implemented to get that on the business side operationally, and then to aid financing.
Thank you. Very diverse perspectives here. We're talking about standardization, not just of the data, but also products, which would probably make you attract investment easily or easier, but also transparency, data transparency when it comes to sharing it with your financiers, quality, but also using third-party platforms that are tried and tested and are pretty much ready to use. Thank you, everybody, for joining us today, and I'm sure the panelists will be happy to answer questions bilaterally if you have any. Please feel free to approach them. Thanks.